So it's Thursday, May 7th, 2026. And we are looking at a really weird situation in the markets today.
Oh, completely. It's kind of completely backward from what you'd expect to see.
Right. Because Inspired Entertainment, they're this, mid-sized gaming company.
Ticker ANC, yeah.
Yeah. And they just told Wall Street, hey, we made less money this quarter. Total revenue's down. And Wall Street's reaction, they sent the stock soaring, like over 11% this morning.
Hitting $8 a share, which is, I mean, it's a textbook market contradiction, right? It completely subverts how we are typically taught to look at business growth. Usually, shrinking top-line revenue triggers immediate panic. Here, it triggered a massive rally.
Okay, let's unpack this, because for this deep dive, we have their Q1 2026 earnings report, we've got the slide deck, and the call transcripts. And the headline numbers show a 5% drop in total revenue.
Right, down to $57.2 million.
But, and this is the crazy part, they beat earnings per share estimates by a massive 13 cents.
Yeah.
They came in at a 2-cent loss versus the expected 15-cent loss. So how does a company make less money but still manage to crush profit expectations so thoroughly that the stock just jumps?
Well, what's fascinating here is that the surface numbers...
The 5% drop.
Exactly. That 5% revenue drop is camouflaging a massive structural transformation. To really understand the stock pop, we have to look at the balance sheet reality.
Okay.
Last year, their Q1 total revenue was $60.3 million. This quarter, it dropped to $57.2 million. But if you look deeper into the slide deck, their underlying revenue actually grew by 15%.
Okay, I see that note in the deck, but, I mean, how can total revenue fall by 5% while underlying revenue grows by 15%? Those sound like totally conflicting realities.
They do, but the 5% drop is entirely manufactured by what management is calling portfolio actions.
Which means what exactly?
It means over the past year, Inspired actively divested from their UK holiday parks business, and they restructured their pubs business. They intentionally shut off those revenue streams.
Okay, I have to push back on the business logic there. Because if you are operating a company and you are actively shedding parts of your business, aren't you just shrinking the pie?
Well, yes and no.
Like, even if those UK holiday parks are struggling, they are still bringing dollars into the building, right? Why would you turn away revenue?
That is a very common assumption, but, it ignores the hidden cost of maintaining those dollars. Think about the logistics of operating physical arcade and betting machines in a UK holiday park.
Okay, so a lot of heavy physical assets.
Exactly. Heavy physical assets that require constant maintenance. You need specialized mechanics, you need logistics, fleets.
Vans, trucks, all that.
Yeah, and personnel just to go around and empty the physical cash boxes.
Oh, right.
The overhead is staggering, which means the actual profit margins on those operations are incredibly thin. You might be bringing in millions of dollars in revenue, but you are spending almost exactly that much just to keep the lights on and the trucks running.
So it's kind of like pruning a garden.
That's a great way to look at it.
Like, if you have a plant and some of the branches are dying, or maybe they're just sucking up all the water and nutrients without actually producing any fruit, you cut them off.
Right.
And the plant gets physically smaller in the short term, but the main trunk grows stronger. Right, that bears way more fruit down the line because all the resources are redirected.
That analogy maps perfectly to their financials.
Yeah.
This wasn't about just losing revenue. It was a really deliberate strategy to exit low-margin businesses. By pruning those heavy, labor-intensive branches, Inspired achieved a massive structural cost reset.
But we can actually see the proof of that in numbers, right?
Oh, absolutely. Look at their adjusted EBITDA, which is essentially their cash profit from day-to-day operations. Because they aren't dragging around those heavy low-margin assets anymore, their adjusted EBITDA actually grew by 29%.
Wow.
Yeah, it hit $23.7 million.
So they generated significantly more actual cash profit despite having fewer total dollars coming in the door.
Exactly. They traded volume for efficiency, and the market realized, oh, wow, the company is significantly healthier being smaller.
Okay, so you cut the dying branches to get leaner. I get that. But the slide deck says their underlying revenue still grew by 15%. You don't grow your core business just by cutting things.
No, you don't.
So where is the new growth actually coming from?
The undisputed star player of this entire earnings report is their shift to digital.
Okay.
They call it their interactive segment.
And the numbers on this segment are wild, like looking at it here.
Right.
Interactive revenue is up 38% year over year.
Hitting $16.7 million. Yeah.
Right. But here's where it gets really interesting. I was looking at the profit margins for this. The adjusted EBITDA margin for this specific segment hit 70.6%.
It's massive. That is over a 700 basis point jump from last year.
Just conceptually, how is a 70% profit margin even physically possible in this industry?
It comes down to the fundamental difference between the economics of physical hardware and digital software. Think back to those pub machines we were talking about. If Inspired wants to put a new game in a pub, they have to literally manufacture a physical steel and glass cabinet.
Right, and load it onto a truck.
Pay a driver to deliver it, pay a technician to install it, maintain it.
So every single new game has a really heavy marginal cost. Every new customer costs them real money to acquire and service.
Exactly. But the interactive segment is purely digital slot games and casino content. They mentioned two specific drivers in the report, games called Mummy It Up and Gold Cash Free Spins Rising Winds.
Catchy names.
Right. But the point is, once a team of software engineers finishes coding those games, the cost to distribute them to one player or 1 million players is essentially zero.
Oh, wow. So the scalability is practically infinite once that initial development cost is paid.
And it creates a compounding effect that physical retail simply cannot match. Think about a casino floor. If you want to introduce a new physical game, what do you have to do?
You have to unplug an older game and physically drag it off the floor to make room? Because floor space is finite.
Exactly. But in the digital space, older game titles provide a stable, recurring revenue base, and the new titles just stack infinitely right on top of them.
Right, because there's no physical limit.
You never have to remove a successful game to make room for a new one. That zero marginal cost paired with infinite shelf space is what drives a 70.6% margin.
And the report highlights how aggressively they are pushing this digital content. Like, they are expanding with existing customers, obviously, but also capturing entirely new geographical footprints.
Yeah, the global expansion is key.
Right. They launched with Betway in South Africa, Fanatics in West Virginia, Superbet in Greece. I mean, they are entering new continents without paying shipping costs.
And you should also look closely at their U.S. performance metrics, because the American online gaming market is arguably the most fiercely competitive landscape in the world right now.
Oh, for sure.
And in the span of just 12 months, Inspired jumped from number 8 to number 4 in the overall slot index ranking.
Wait, really? Number 4?
Yeah.
That's a massive leap to make in a single year against, entrenched competitors.
It really is. It shows the content is resonating with players. They now capture 4.2% of the total U.S. online gross gaming revenue.
Which, 4.2% sounds like a small slice of the pie.
It does, but you have to remember the U.S. market is doing billions of dollars in volume. Capturing over 4% of that total volume while operating at a 70% margin is highly lucrative.
I bet. Now, your first instinct hearing all those digital numbers is probably to assume physical retail is totally dead.
Right.
Like, you'd think Inspired is just going to pivot into becoming a 100% digital software company.
Yeah.
But based on the data here, retail isn't dead at all. It's just becoming incredibly targeted.
Yeah, they didn't abandon retail. They optimized it. Even after selling off the holiday parks and, restructuring the pubs, their retail solutions adjusted EBITDA margin jumped to 45.1%.
Which is phenomenal for a physical business.
Truly.
And the performance metrics on the machines they actually decided to keep are fascinating. William Hill betting shops in the UK are up 9% in gross win per unit per day. Greece is up 11%.
Yeah. How are they making almost 10% more money every single day on physical machines when the broader trend is shifting so heavily to mobile phones?
It is entirely driven by the hardware upgrade cycle.
Okay.
They aren't leaving old, dusty, 10-year-old machines in these premium locations. They are aggressively deploying brand new, state-of-the-art hardware, but only where the foot traffic justifies the investment.
Right.
The report specifically highlights the rollout of their new Valiant cabinet. They completed 120 of these machines for Jennings Bet in the UK, and they installed over 1,000 new terminals in Greece.
Okay, but from a consumer behavior standpoint, how does a new cabinet actually make someone spend 9% more money? Like, it's the same fundamental math underneath the game, isn't it?
The math of the game might be similar, yes, but the user engagement is completely different. Think about the psychology of a crowded betting shop.
Human attention is naturally drawn to the brightest, smoothest visual experience in the room. The Valiant cabinet features larger, high-definition curved displays, dynamic lighting, and crucially, much faster internal processors.
Oh, so the machine isn't lagging while someone is trying to place a bet?
Precisely. If a game loads faster between spins or hands, the player gets more iterations of that entertainment in a shorter period.
Right. Nobody likes waiting.
Exactly. A sluggish, dim screen feels unlucky, or it's just frustrating. A crisp, fast screen keeps the dopamine loop tight and keeps the player engaged. That enhanced user experience is the exact mechanism that drives what they call cash box growth ahead of the broader market.
That makes sense.
In fact, the report notes that in Illinois, their net terminal income is actively over-indexing the floor average.
Okay, translate over-indexing for me in this context. What does that look like?
It means if you look at a row of 10 different machines from 10 different manufacturers on a casino floor in Illinois, the inspired machines are disproportionately popular. They are pulling in more cash than the machines sitting right next to them.
Ah, I see. So they've essentially raised the floor on what they consider an acceptable physical asset.
Yeah.
If a machine isn't over-indexing, or if it's just sitting in a low-margin holiday park, they just don't want it in their portfolio anymore.
Exactly. They are acting ruthlessly to protect their profit margins.
Now, it can't all be 70% margins and flawless execution, right? To give a fully balanced view of these sources, we need to look at the one area where they actually lost some ground. Their virtual sports segment took a bit of a hit.
It did, yeah. Virtual sports revenue dipped 3% year over year, and the report notes this was largely driven by lower revenue from one key online customer.
What actually is virtual sports? Because I hear that term and I immediately picture like people playing FIFA or NBA 2K on a PlayStation.
Right, yeah, it's a completely different product. It's designed specifically for betting operators.
Right.
Imagine a highly realistic, computer-generated simulation of a horse race, a soccer match, or a basketball game. The graphics look exactly like a live television broadcast, but the outcome is driven entirely by a certified random number generator.
Oh, okay. So it's basically a slot machine dressed up to look like a live sporting event.
Exactly. And the appeal for the betting operators is constant inventory. Think about real-world sports. They have off-seasons, games get rained out, matches only happen at scheduled times.
Right. You can't bet on a live game at 3 a.m. on a Tuesday.
Exactly. But virtual sports run continuously, 24 hours a day, 7 days a week, with a new event starting every 3 minutes.
Wow. Okay, so if it provides this constant inventory, why did the revenue dip 3%?
Because unlike the physical machines that just sit in a betting shop, digital virtual sports are highly dependent on the distribution platforms of third-party sportsbooks.
Oh, I see.
So losing traction or prime placement with one key online customer can cause a temporary blip in revenue. However, management spent a significant amount of time on the earnings call outlining massive catalysts on the immediate horizon to reverse this.
Yeah, I see they are aggressively expanding their distribution channels.
Yeah.
Like they just launched an agreement with BetMGM in the first quarter.
Yeah.
And they signed a new distribution agreement with Playtech for the second quarter.
Those are enormous global platforms.
Yeah.
Getting prime placement on BetMGM or Playtech provides incredible incremental reach for their virtual products. But the real catalyst they highlight is product-driven.
Yeah.
They are rolling out a new software update called Virtual Soccer 4.0, featuring a bet builder functionality, and they are timing this specifically ahead of the World Cup.
The timing there makes total sense. During a World Cup, you have literally billions of people tuned into soccer.
But consider the downtime. A soccer match is only 90 minutes long, and there are hours or sometimes days between your favorite team playing. Major global sporting events create a massive ecosystem of peripheral engagement.
So if I'm a fan on a betting app, and I'm waiting for the real World Cup match to kick off in 30 minutes, the app offers me a highly realistic virtual soccer match to engage with in the meantime.
Yes. It captures that spillover excitement. They're leveraging the cultural momentum of a real-world event to drive traffic right into their high-margin virtual products.
Okay, so we have all the individual puzzle pieces on the table now. We've got the pruning of the low-margin retail footprint, the explosion of the digital interactive segment,
Yep.
the smart deployment of those new Valiant cabinets on the retail floor, and the World Cup catalyst for virtual sports. Now, let's look at the ultimate scorecard for any business. Cash flow and the 2026 outlook.
Yeah.
Where is all this money actually going? Are they just hoarding it?
This is where the narrative really crystallizes for investors, because their net operating income skyrocketed 475% to $9.2 million.
Unbelievable.
And more importantly, they generated $15.8 million in free cash flow. To put that in perspective, that is a 66.8% conversion rate from their adjusted EBITDA. Wait, meaning for every dollar of profit they generate on paper, nearly 67 cents is actual cold hard cash that they can deploy.
Exactly.
Rather than having it tied up in inventory or, accounts receivable, generating nearly $16 million in free cash in a single quarter for a company of this size is a phenomenal position.
It is, and they are deploying it very aggressively. They paid down $13.3 million in long-term debt, and they repurchased $2.6 million of their own common stock. Through those actions, they brought their net leverage ratio down from 3.3x to 3.0x.
Translate that leverage ratio for me. What does going from 3.3x to 3.0x actually mean for the health of the business?
Think of it like paying down the mortgage on a rental property. The leverage ratio measures how much debt the company has relative to its cash flow. By using their free cash to pay down debt, they are actively bulletproofing their balance sheet against future economic downturns or higher interest rates.
Right.
And the fact that they are doing this while simultaneously buying back their own stock sends a very clear signal. Well, yeah. To me, buying back stock while paying down debt is the ultimate sign of a management team putting their money exactly where their mouth is. They fundamentally believe the stock is undervalued by the broader market.
If we connect this to the bigger picture, the cash flow validates the entire restructuring thesis. This earnings report is documentary evidence of Inspired Entertainment successfully transitioning from a volume-based business to a margin-based business.
Right.
A volume business just wants to be as big as possible, collecting pennies on the dollar just to show massive top-line revenue. That was the old strategy with the sprawling UK holiday parks and pub footprints.
But they traded that low-quality, heavy revenue for high-quality, highly scalable cash flow. They proved to Wall Street that they could shrink the top line, yet radically expand the bottom line.
Which gave management the confidence to reaffirm their 2026 full-year adjusted EBITDA target of $112 to $118 million. But the crucial detail, the piece of data that likely drove that 11% morning stock pop, is that they raised their margin guidance. They were previously targeting a 43% margin, and now they are targeting up to 45%.
Wow. Raising profit margin guidance in the current macroeconomic environment is incredibly rare.
It signals to the market that their digital mix, that interactive segment running at over 70% margins, is growing even faster as a percentage of their total business than management initially projected.
It really is a masterclass in corporate strategy. So why should you care about a mid-cap gaming company's earnings report? Because it's a profound lesson in capital allocation and, honestly, the courage to shrink a business in order to make it vastly more profitable.
Absolutely.
It goes against every instinct we have to make things smaller. It requires management to leave their ego at the door and stop chasing vanity metrics. Look at your own projects, your own business, maybe even your own daily habits. Are you holding on to your own version of a UK holiday park?
Right, those things that look good on the top line.
Exactly.
Things that make you look busy or successful on paper, but are actually a massive drag on your overall margins and your energy. Pruning the garden is painful in the short term. The plant looks smaller, but it is the only way to get that 29% growth in the things that actually matter.
It's a critical exercise in distinguishing the appearance of growth from actual value creation.
Before we wrap up, I want to leave you with a final thought to ponder. We spent a lot of time praising this pivot to digital and the infinite scalability of software. But let's look down the road. With Inspired's interactive digital segment running at that blistering 70.6% margin, what happens when this online market reaches total saturation?
Because high margins always attract fierce, well-funded competition. As competitors invariably copy their content strategy, reverse engineer their most popular games, and flood the online gaming market with their own digital titles, will Inspired be forced into a race to the bottom on pricing to maintain that U.S. market share? Or is there a natural ceiling to how profitable digital gaming can actually get before the house finally loses? Navigating the next phase of this transformation is going to require constant, precise pruning.